Delaware architecture we have built across this series is engineered for one purpose: offensive deployment, capital formation, tax efficiency, and institutional credibility inside the most liquid, most legally predictable markets on Earth. Every structural decision made in the preceding episodes was optimized for growth inside the United States. But that optimization has a cost that most family offices never model until the moment it becomes irreversible. When your ultimate beneficial ownership is traceable to a US-domiciled structure, you are not simply a participant in American markets. You are a subject of American sovereign authority, and sovereign authority is not static. The historical record on this point is unambiguous. In 1933, Franklin Roosevelt issued Executive Order 6102, compelling every U.S. person to surrender privately held gold to the Federal Reserve at a fixed government price. The asset class was not taxed into submission. It was confiscated by executive decree. In 1941, the U.S. Treasury froze all Japanese, German, and Italian assets held in American institutions within 72 hours of political decisions being made in Washington. No court order, no individual due process, a sovereign decision executed administratively. More recently, the post-2008 FATCA framework extended U.S. tax jurisdiction to every foreign financial institution, Earth that holds accounts for U.S. persons, and compelled those institutions to report or face a 30% withholding penalty on all U.S. source income. The pattern across these events is identical. When the fiscal or geopolitical calculus shifts in Washington, the sovereign moves first and litigates later. The most immediate and structurally significant threat to non-U.S. family offices operating through U.S. vehicles is the Corporate Transparency Act, enacted in 2021 and phased into enforcement through 2024. The CTA requires virtually every LLC, LP, and corporation formed in the United States to disclose its beneficial owners to FinCEN, the Financial Crimes Enforcement Network. The disclosure threshold is deliberately broad. Any individual who owns 25% or more, or who exercises substantial control over a reporting company, must be identified by name, date of birth, residential address, and a government-issued identification document. That data sits inside a federal database. It is accessible to law enforcement, regulators, and under specific treaty frameworks, foreign governments. For a family office that has spent years building layered anonymity into its Delaware architecture, the CTA is not an inconvenience. It is a structural breach. There are 23 exemptions under the CTA, and institutional advisors have spent considerable time mapping their client structures against those exemptions. Large operating companies, SEC registered investment advisors, and certain pooled investment vehicles may qualify. But the typical single-family office, a Wyoming LLC or Delaware LP, holding a diversified portfolio of private equity, real estate, and liquid securities, does not fit cleanly into any exemption category. The CTA exposure is real and it is permanent. Every change in beneficial ownership, every new entity formation, and every change of address triggers a fresh reporting obligation within 30 days. The administrative burden alone forces a level of transparency that fundamentally changes the risk calculus for offshore principals who have been using U.S. structures as their primary deployment vehicle. The traditional response to U.S. sovereign exposure has been to move assets offshore and label the outcome asset protection. That framing is not wrong, but it is incomplete. Asset protection is a defensive posture. It assumes a threat has already materialized and responds to it. What the architecture we are describing requires is something more deliberate and more dynamic. Jurisdictional arbitrage is the active, ongoing management of capital across sovereign lines so that no single government holds complete dominion over the consolidated estate. It is not a one-time filing. It is a continuous structural discipline, updated as regulatory environments shift, treaty networks evolve, and the family's operational footprint changes across jurisdictions. The multi-vector approach to jurisdictional arbitrage operates simultaneously across geographic, instrument, and temporal dimensions to ensure no single regulatory action cascades across the entire estate. Each instrument in the multi-vector stack serves a distinct structural function. The LLC, whether Delaware or Wyoming, is the operational engine. It is optimized for US citus asset holding, pass-through taxation, and contractual flexibility. It is not optimized for sovereign insulation. The private foundation, most commonly structured under Liechtenstein, Panama, or Dutch law, is a legal person with no shareholders and no beneficiaries in the traditional sense. Assets transferred into a foundation are no longer owned by the settlor. They are owned by the foundation itself, governed by its charter. That separation of legal title from economic benefit is the foundation's core protective mechanism. The trust sits between these two instruments. It retains the flexibility to distribute economic benefit to identified beneficiaries while placing legal title with a professional trustee in a jurisdiction whose courts will not automatically enforce foreign judgments against the trust corpus. The Cyprus holding layer functions as the first sovereign buffer between the US operating vehicle and the ultimate offshore ownership structure. But its effectiveness is entirely contingent on one thing: genuine economic substance. A Cyprus entity that exists only on paper, a registered address, a nominee director, and a bank account that mirrors instructions from a US principal will not survive regulatory scrutiny. The OECD's Base Erosion and Profit Shifting Framework, and specifically Action 5 on harmful tax practices, requires that entities claiming treaty benefits and preferential tax treatment demonstrate that genuine management and control is occurring in the jurisdiction. The US Treasury's look-through doctrine operates on the same logic. If substance cannot be demonstrated, the Cyprus layer is recharacterized as a conduit, and the beneficial owner is treated as if the offshore structure does not exist. The substance checklist that auditors and regulators apply to a Cyprus holding entity is specific: board meetings physically conducted in Cyprus, local bank accounts with active operational activity, local tax residency certificates, and locally employed staff. Above the Cyprus holding layer sits the trust overlay, the instrument that severs legal ownership from the beneficial owner at the level of the ultimate holding structure. Not all trust jurisdictions provide the same level of protection, and the distinction that matters most in the context of sovereign risk is the quality of the jurisdiction's firewall legislation. Firewall legislation is statutory law that explicitly limits the ability of foreign courts to reach assets held in a domestic trust. The Cook Islands, the Cayman Islands, and Nevis are the most established jurisdictions in this category. Their domestic statutes explicitly state that a foreign judgment, including a US federal court judgment, is not enforceable against a local trust unless the trust itself was created with the intent to defraud a specific creditor at the time of settlement. Within the category of firewall trusts, there is a critical structural distinction between what practitioners call shield trusts and asset protection trusts. A shield trust is designed primarily to defend against involuntary claims, creditors, judgment holders, and in some configurations, forced heirship rules. Its primary function is defensive. An asset protection trust, more accurately described as a discretionary offshore trust, is designed not only to defend against claims, but to actively manage the distribution of benefit across generations, jurisdictions, and changing family circumstances. The trustee holds full legal title and exercises full discretionary authority over distributions. The settlor retains no legal right to demand distributions. That discretionary structure is what makes the trust genuinely effective against a US court order. There is no legal right for the court to compel because no legal right exists. The instrument through which a settlor maintains practical influence over a discretionary trust without retaining legal control is the letter of wishes. This document is not legally binding. It does not create enforceable rights. And those two facts are precisely what make it structurally valuable. Because it creates no legal obligation, it cannot be used by a court to recharacterize the trust as a sham or to establish that the settlor retained control. The letter of wishes communicates the settlor's preferences preferred beneficiaries, distribution priorities, investment philosophy, geographic restrictions on asset deployment, succession planning preferences, and the conditions under which the trustee should consider accelerating or deferring distributions. A well-drafted letter of wishes will also include a mechanism for the settlor to communicate updated preferences to the trustee without triggering a formal trust amendment, and will specify the circumstances under which the trustee is expected to exercise independent judgment in contradiction to the settlor's expressed wishes. The architecture is only as strong as the discipline applied to maintaining it. The annual maintenance cycle for a multi-jurisdictional structure of this complexity has 4 components. The first is compliance reporting. Every entity in the stack has its own reporting obligations. FinCEN beneficial ownership updates for the Delaware vehicle, CRS and FORCAR, reporting for the Cyprus entity, annual trustee accounts for the offshore trust, and in most cases, personal tax filing obligations for the beneficial owner in their country of residence. These obligations run on overlapping schedules across multiple jurisdictions, and missing a single deadline can trigger a cascade of inquiries. The second component of the annual cycle is KYC maintenance. Every financial institution holding accounts in the name of any entity in the stack will conduct periodic KYC reviews. The family office must maintain a KYC pack for each entity, a standardized document set including current certificates of incorporation, current beneficial ownership declarations, certified copies of director identification, audited financial statements, and source of funds documentation that can be provided to any institution within 72 hours of a request. The third component is documentation readiness. At any point, the beneficial owner's advisors must be able to produce, for every entity in the structure, a complete file of substance evidence, board minutes, bank statements demonstrating operational activity, tax residency certificates, and legal opinions confirming the entity's status. That file must be current. A board minute from 3 years ago and a lapsed tax residency certificate are not a defense. They are confirmation that the substance was not maintained. This is the completed institutional architecture. A Delaware vehicle is the operational engine, optimized for US Cyprus asset deployment and domestic tax efficiency. A Cyprus holding layer with genuine, documented, and annually maintained economic substance as the first sovereign buffer. A multi-jurisdictional trust structure settled in a firewall jurisdiction, administered by an independent professional trustee, and guided by a carefully drafted letter of wishes as the ultimate ownership layer, sitting outside the direct reach of any single government. The maintenance phase begins next. The architecture is built. Now it must be run.
Join our community of informed investors to stay ahead. This data is for education and is not financial advice. Always consult a professional before investing. To speak with one of our specialists, click the link in the description. I'll see you in the next report.